Ladies and gentlemen, can I please have your attention? I've just been handed an urgent and horrifying news story, and I need all of you to stop what you're doing and listen.
Mortgage rates have increased about 1 percentage point over the last 30 days to the highest rates we've seen since 2009. And the 30-year fixed mortgage rate as of this week just jumped to
Cannonball!
What's up, everybody? Johnny Cresswell with eXp Realty here in Virginia Beach with another 5-Minute Friday where I break down a real estate question in about 5 minutes. Let's talk mortgage rates in 2022. Mortgage News Daily just released an article this week on April 11th going over the jump to 5.25%, which is the highest rate we've seen since 2009. Before you go all Chicken Little on me, let's dive into some context and discuss. If you get any value out of this video, please like and subscribe and consider sharing with a friend to help them and this channel. I really appreciate it. I'm going to be flowing through this article from Mortgage News Daily so that I can keep it as simple as possible. In the last 30 days, mortgage rates have increased about 1 percentage point, which is about 2 percentage points higher than this time last year. To quote the article, Matthew Graham writes, "The last few days of March offered some hope that 2022's massive rate spike might be slowing down. The first few days of April crushed those hopes, and things have only gotten worse as the new week begins." To add context to massive, Graham mentions this is not an overstatement, considering this is the biggest, fastest jump in mortgage rates since at least 1994. But the why is fairly straightforward. Blame the Fed. Just kidding. But seriously, the Federal Reserve does set the Fed funds rate, which is the short-term rate that banks charge each other for overnight lending. Let's keep in mind the long-term target range for inflation is between 2 to 2.5%, but it currently sits near 8%. This increase in the federal funds rate is an attempt to control that inflation. Basically, to condense this, a way for the Fed to influence both short and long-term rates, the Fed fund rate is cut to zero. Then they buy bonds, which creates excess demand in the bond market, which in turn pushes longer term rates lower. At the start of the pandemic, financial markets were in chaos, and the Fed stepped in to cut rates from 1.6% in February of 2020 to essentially 0% by April, and buy bonds at a faster pace than ever before. Cutting the Fed funds rate plus the purchase of all of those US Treasuries and mortgage-backed securities led to a quick decrease in mortgage rates, with a record low coming in at 2.65% in January of 2021. Instead of slowing bond purchases, the Fed figured, let's just pump more monetary stimulus, with the assumption that COVID-driven inflation would subside at the same time the pandemic subsided.
Talk about your all-time backfires.
Well, the pandemic is subsiding, but inflation is not. Lumber costs have quadrupled, new car and used car prices have gone up about 12%, and food prices are climbing as well. The Fed admits to a massive miscalculation in regards to this persistent inflation. Graham puts it like this: as 2022 approached, we suddenly found ourselves staring down the barrel of the biggest inflation numbers and the tightest labor market in decades. Meanwhile, the Fed still had its Fed funds rate at 0% and was still buying more than $100 billion in bonds each month. Graham's analogy is a battleship in a river. The Fed changed their heading back in September of 2021 by slowing bond purchases, which is something that needed to happen before they could jack the rates back up. As we can all attest, because we've all lived this and experienced it, inflation has continued to inflate. So the Fed accelerated their exit from easy money policies. This rapid rethink and rapid removal of bond buying demand on the part of the Fed is the key ingredient in the rate spike seen so far in 2022. Fed Vice Chair Lael Brainard on Tuesday morning, April 5th, hinted at the Federal Reserve kicking off its process of shrinking its asset holdings in the next meeting coming up in May. Referred to as normalization, Brainard talked up the possibility of extremely large reductions in Fed bond buying faster than 2017's normalization. To dive deeper into this normalization process, the minutes from last month's meeting were released and they dropped a veritable bombshell. 2017's normalization was a $4 billion per month hit to mortgage-backed securities, whereas 2022's phase 1 is a staggering $35 billion per month. Here we see a depiction of how the 10-year Treasury yield reacted to all of these events from the time that Brainerd made her comments to when the Fed minutes were released the following day. And Graham notes in the article that mortgage rates care about 10-year yields because 10-year yields speak to trends in longer-term rates in general. He represents this being loosely tied together with this graph. It's not perfect, but every time the yield increases or decreases, the mortgage rates follow. I'll leave a link to my video about the Treasury yield and its ability to act as a mortgage rate indicator somewhere on the screen and in the description below. Definitely check that out to get a 5-minute breakdown. Graham notes we're waiting for several key developments, but most importantly, inflation data and a sign that they're shifting. With all of this, we're in a wait and see situation to see what triggers the Fed pulls in their meeting in May. Certainly they'll be hiking, probably by 0.5%. They're also likely to enact the normalization plan laid out in last week's minutes. If that's the extent of the damage, then the market will finally be on the same page with the Fed. Paradoxically, that means the rate hike and big reduction in bond buying could actually be a good thing for longer term rates. To simplify all of this, there have been past occasions where the federal funds rate increased, yet mortgage rates have decreased. I think I'm going over 5 minutes on this one, but I want to make sure I give you the best information that's available so you can make better decisions going forward. There's never been a truer statement regarding mortgage rate forecasting than the one made by Mark Fleming, the chief economist over at First American. You know, the fallacy of economic forecasting is don't ever try and forecast interest rates and, or more specifically, if you're a real estate economist, mortgage rates, because you will always invariably be wrong. Coming into this year, most experts projected mortgage rates would gradually increase and end 2022 in the high 3% range. It's only April and we've already blown past those numbers. Freddie Mac, which tracks mortgage rates separately from Mortgage News Daily, announced last week that the 30-year fixed rate mortgage was at 4.72%. Danielle Hale, the chief economist for Realtor.com, tweeted out on March 31st, continuing on the recent trajectory would have mortgage rates hitting 5% within a matter of weeks. Just 5 days later, on April 5th, Mortgage News Daily quoted rates at 5.02%, and then a week after that, they went up again. No one knows how swiftly rates will rise moving forward. However, at least to this point, it hasn't really affected buyer demand. Ali Wolf, chief economist over at Zonda, explains, mortgage rates jumped much quicker and much higher than even the most aggressive forecast called for at the end of last year. And yet, housing demand appears to be holding steady. Through February, home prices, the number of showings, and the number of homes receiving multiple offers all saw substantial increases. But much of the spike in mortgage rates increased in March, and we won't know the potential impact of that until those March housing numbers come out in early May. Rick Sharga, EVP of Market Intelligence over at Atom Data, recently put rising rates into context. Historically low mortgage rates and higher wages helped offset rising home prices over the past few years. But as home prices continue to soar and interest rates approach 5% on a 30-year fixed-rate loan, more consumers are going to struggle to find a property that they can comfortably afford. And here's the bottom line. While no one knows exactly where rates are headed, experts do think they'll continue to rise in the months ahead. In the meantime, if you're looking to buy a home, just know that rising rates do have an impact. As rates rise, it'll cost more for you to purchase a house. If you're ready to buy, it may make sense to do so sooner rather than later. And I've said this before, you shouldn't base your desire to buy on a mere interest rate. You buy when you're ready. You buy if you can and you rent if you must. You should buy a house when you're ready, willing, and able to take that next step for you and your family. Besides, refinancing down the road is always an option, but the money you dropped in the rent check box is helping somebody else refinance down the road. Well, I hope this provides some clarification as to what's been going on with mortgage rates. So comment below with your biggest takeaway. Mine is the cutting of the Fed funds rate coupled with purchasing bonds influences both short and long-term rates, ultimately lowering mortgage rates. Again, if you gain any value or insight from this video, please like, comment, and subscribe. Be sure to come back next week for another 5-Minute Friday when I break down another real estate question in about 5 minutes. Thanks for watching, and I'll catch you on the next one. Mortgage rates in 2020. Hadouken! Mortgage rates. Mortgage rates in 2022. So weird. If you get any value out of this video, my Filipino, all of a sudden, Johnny. Whereas 2022's phase. No.